Welcome to the Discovery Clock series.
When the paperwork was finalised in 1990, Rainer Emil Gut finally had his prize. Credit Suisse now owned First Boston. On paper, it was supposed to be a financial masterstroke that created a new Swiss global powerhouse. But, in reality, fusing Swiss conservatism with Wall Street ambition was famously described by financial observers as mixing oil and water. You could force them into the same corporate structure, but they would never truly blend. This fundamental incompatibility sparked a bitter, decade-long civil war. In Zurich, at the bank's headquarters on Paradeplatz, banking was viewed as a multi-generational stewardship. Credit Suisse was a 134-year-old institution built on a philosophy of extreme capital preservation. The bank was managed by committees. Decisions required deep consensus. Risk was something measured over decades, and loyalty to the institution was paramount. But, across the Atlantic, in Manhattan, First Boston operated on an entirely different logic. The culture was that of a mercenary enterprise. Performance was fiercely individualistic, and compensation was tied directly to the fees a banker could generate in a single quarter. The star deal makers held client relationships that were theirs personally. Loyalty was measured exclusively in bonus payouts, not tenure. Zurich technically held the authority over the new entity, but it was New York who generated the massive advisory fees. And this dynamic quickly created a profound hostage situation within the bank. First, Boston was led by aggressive American executives like John Hennessy, and later, Alan Wheat. These were Wall Street veterans who understood exactly how much leverage they held over their Swiss bosses. Credit Suisse needed First Boston's top talent to justify the billions of dollars they had just spent on the acquisition. The Americans knew this. Whenever Swiss executives tried to enforce traditional risk limits or attempted to cap the exorbitant bonus pools, First Boston's top rainmakers deployed a simple, brutal threat. They would walk across the street to Goldman Sachs or Morgan Stanley, and they would take their billionaire corporate clients with them. Terrified of losing the very engine of their revenue, the executives in Zurich repeatedly surrendered. To satisfy the relentless demands of the New York's trading floor, Credit Suisse's leadership began prioritizing short-term return on equity above all else. And, by the late 1990s, Credit Suisse's bonus pool was among the most generous on all of Wall Street. The Swiss risk-adverse mindset began to slowly disappear. The risk committees that had protected the bank for over a century were deliberately hollowed out by a decade of concessions. A tragic shift had occurred. A conservative Swiss bank had paid billions of dollars to become a hostage to its own subsidiary. The First Boston mindset was no longer just a business strategy. It had become a cultural virus, a pathogen that slowly eroded long-term integrity in exchange for immediate financial reward. And having successfully infected its Swiss parent, the American dealmakers were about to package that exact same virus and export it to the rest of corporate America. And unfortunately, this would lead another well-known company falling prey to this toxic cultured mindset. In 1996, Boeing, a company proudly run by engineers, acquired its struggling rival, McDonnell Douglas, for $13 billion in a merger orchestrated by Credit Suisse First Boston. The deal was driven by John Craig Oxman, an American First Boston deal maker who pushed a financially flawless strategy that completely ignored the human cost.
Breaking news, an Ethiopian Airlines flight has crashed shortly after takeoff from Addis Ababa, killing all 157 passengers and crew thought to be on board. The airline told state media there were people of more than 30 nationalities.
Though Boeing bought the company, it was McDonnell Douglas who effectively took over Boeing's management and work culture. Led by executive Harry Stonecipher, they deliberately dismantled Boeing's meticulous engineering soul to prioritize short-term Wall Street returns instead. The profound irony of this is that the exact same cultural virus Credit Suisse First Boston exported to Boeing was quietly eroding Credit Suisse itself from within. Credit Suisse had long been guided by Swiss executives who were inherently bound to the country's ethos of caution and long-term stability. But by the early 2000s, that heritage was abandoned. The executive suite became a revolving door for foreign executives and Wall Street veterans who lacked that inherent Swiss mindset. In 2001, the American investment banker John Mack, a man famously known on Wall Street as Mack the Knife, was brought in as co-CEO. And in 2007, the board handed the CEO position to Brady Dugan, an American equities trader who had come straight out of the First Boston machine. The multi-generational stewardship of Zurich had been officially replaced by the survival instincts of Wall Street, and almost immediately that new instinct was put to the ultimate test. Just 1 year after Dugan took the helm, the 2008 global financial crisis tore through the world economy. Directly across Paradeplatz in Zurich, Credit Suisse's fiercest rival, UBS, crumbled under its own weight of toxic American mortgage debt. UBS was forced to accept a humiliating bailout involving a $60 billion fund to absorb its toxic assets and the direct capital injection of over $5 billion just to keep its doors open. Credit Suisse, however, navigated the panic much differently. Under Brady Dugan's leadership, the bank proudly refused state aid. But they still needed money to survive. So they turned to a very specific, pre-existing relationship that they trusted: their own private banking clients. Indeed, for years, Credit Suisse's wealth management division had actively catered to Middle Eastern royalty. One of their most prominent clients was Hamad bin Jassim Al Thani. He was not only the Prime Minister of Qatar, but crucially, he was the head of the country's sovereign wealth fund, the Qatar Investment Authority. Leveraging this elite private connection, Credit Suisse scrambled to raise 10 billion Swiss francs in emergency private capital, anchored heavily by the Qatari fund. They survived the Great Crash without a taxpayer rescue. The financial press praised them. But the hidden reality of the Qatari Rescue was staggering, and it revealed the true priorities of the men running the bank. Why did Credit Suisse go to Qatar instead of Bern? Because a Swiss government bailout came with heavy, non-negotiable strings attached. Taking state money meant the government would demand severe oversight. They would slash executive pay, and they would strictly cap the massive bonus pools. To the Wall Street bankers now running Credit Suisse, losing their bonuses was simply unacceptable. So they turned to Qatar. But the Middle Eastern capital did not come cheap. To avoid government interference, Credit Suisse agreed to highly predatory terms. They issued convertible notes to the Qatar Investment Authority that carried exorbitant interest rates, some exceeding 10%. Over the next decade, Credit Suisse would bleed billions of dollars in interest payments just to service that specific debt. The executives had essentially mortgaged the long-term financial health of a 150-year-old bank entirely to protect their own short-term compensation. And the psychological damage of that survival was even worse. Because they hadn't taken government bailout money, Credit Suisse felt vindicated. They developed a culture of arrogance and a fatal sense of being invincible. In the aftermath of the 2008 crisis, most major global banks spent the next decade reining in their traders, cutting risk, and reforming their corporate cultures. But Credit Suisse believed their aggressive model was bulletproof. They ignored the shifting regulatory winds. They kept their foot firmly down, actively courting the high-risk, high-yield clients that other banks had specifically blacklisted. The arrogance born in the 1980s, exported to corporate America in the 1990s, and validated by the crash of 2008, was now permanently embedded in the foundation of the Swiss bank. Credit Suisse had successfully captured Wall Street, but they had sold their soul to do it, quietly setting the stage for one of the most spectacular collapses in modern financial history. Hello everyone, thank you for watching the video and for your patience and support. Please consider subscribing and sharing the video, and as always, see you in the next one.